Hi everyone, it's Stuart here. Hope you can hear me loud and clear. Let me just check everything's working. Looks like everything's on okay. It's the audio normally, sometimes it's not working. Video looks all right. Audio sounds okay. So let's crack on. If you've got any problems, please obviously reconnect to either your YouTube, your Twitter, or your X, still can't call it X, your Twitter channel, your X channel, or your Facebook channel. So good evening everyone, good morning, good day, wherever you are in the world. Today, we're going to look at swing trading strategies. I've got 4 I'm going to try and get through in the next hour. If we don't, I've probably got 5 or 6 I could show you. I'll do another session on swing trading if people are interested. But today, obviously, we've had we had the PPI data today, which came in hotter than expected. Let me just show you quickly the trading calendar. So yesterday, remember, CPI came in much hotter than expected, the key core figure. And again, today, where are we? Wednesday the 12th, Thursday the 13th, isn't it? Thursday the 13th, PPIs come in hotter than expected. Where are we? Thursday, we had a bit of growth. Good news out of the UK. GDP was much better than expected. But the key US data, here we are, PPI, stronger than expected. The core number, 3.6% on an annualized basis. So remember we had that shock yesterday, 3.3% for the CPI data. But again, jobs remains very, very robust. So 213,000, and the the pressure that builds to the market, and obviously this issue about immigration being curtailed quite significantly and people expelled out of the US. So, that's just adding to that mantra of a strong, tight jobs market in the United States. So core PPE, remember that feeds into CPI. So CPI is expected to tick up, but some people were saying yesterday after the data that perhaps it was just, and it was actually just sort of parts of it. It wasn't the whole, or it wasn't across the board within the measure of consumer prices. However, we see what CPE looks like, or at the end of the month as well. That's the key one. Remember that the Fed look at more than CPI or PPI. But anyway, and the monthly number, 0.4 of 1%. Big upgrade for last month as well from, I think it was 0.2, I think it was. It doesn't actually show me on that. Yeah, 0.2 to 0.5. So big uplift in that, and 3.5% for the headline numbers for PPI as well. And even when you're stripping out food and energy, it was still hotter than expected. And again, upgrades for the December data, 0.2 of 1% to 3.5% for PPI. So that the story about inflation and the expectations of the Fed now down after yesterday's CPI and today's PPI down to 1 cut this year. Some participants are obviously still talking about potentially 2 cuts. There's a guy from Evercore on, I think it was on CBS earlier on, still looking for 2 cuts from the Fed. Others are talking about rate hikes potentially before the year's out. Personally, I can't see that happen, but it doesn't really matter what I think or my view. We just trade the charts and the markets according to see. So on that, let's have a look at what we were going to talk about today. We'll come back to the markets if we've got some live markets later. We'll show these examples with some live charts as well as the slides. I think it's always better to do it live, isn't it? You can see that if there's any sort of reaction, you can see how these strategies work in shorter timeframes. But really, swing trading is designed for the higher timeframes. So I'll say an hour, 4 hour, particularly the daily timeframe is where swing trading strategies come into their own. So let's crack on. And Trump's just announced reciprocal tariffs on all his trading partners. So how that's going to be administered, and the logistics of it all just beats me at the moment. But anyway, and one of the key countries probably be hit quite significantly will be India, and Mr. Modi is there currently. So anyway, enough politics for the moment. So let's crack on. So that's me. You don't want to see my ugly mug, but I've been around a long time. Basically, it's all about keeping things simple. It certainly is the way I approach the markets. Do what's probable, keep it simple, and look at the time frame. But most importantly, know yourself and trade what fits your personality. whether it's an asset, whether it's the time frame, whatever it works for you. So what is swing trading? I say with thanks to Trevor Neal. Trevor Neal's a bit of a mentor of mine. He probably doesn't know it, but he's a highly qualified technical analyst. He's been around, I think it's 50 years this year since he was in the pits in the UK. But very great, very good teacher. Does a very good course. If you've got availability to get to any of Trevor's courses, do take it up on it. And he runs a free session for Reuters clients as well. So that's when I first came across him. Liquidity, time frame, and keep it systematic. That's the key thing about any type of trading, but particularly when we're talking about swing trading. We want liquidity, we want the key time frames, and we want a systematic approach. What makes a good swing trader? What are the attributes and the characteristics that this particular type of trading are best suited for? And then we're going to hopefully, if we've got time, we'll go through three or four. I've got four here. We'll actually get through them all in an hour, because I do need to go within 60 minutes, because I have a habit of talking for too long. But I do need to go at 8 o'clock my time. So we're going to look at two simple indicators. The SMA, the simple moving average. We're going to use it on 7. We're going to use RSI down at 7 as well. Get a bit of the flexibility. The lower the number, we get more peaks and troughs. And we're going to change the overbought and the oversold areas. We're going to bring them in, make the range a bit tight, and you see how that impacts things. So a simple moving average RSI strategy. We're going to go through the parabolic SAR and MACD setup. We have that as one of my standard templates on the Trade Locker platform. Then we'll look at exponential moving average. We're using 3, 5, and 21 in this example. My default on a day-to-day basis is 9, 5, and 21. So very similar. It's just the shorter time frame. The quicker time frame is closer to the price action. And again, it's not. I don't particularly going to get hung up on the actual numbers when we're using a moving average crossing strategy. It's just the technique and the process. So if you're using 5, 9, 21, or 9, 13, 15, or whatever it is you're using, and it might no one use 2 rather than 3, it's up to you. But the process is the key thing. You need alignment in the moving averages. You need to accept you'll get a lot of false triggers, but when they do run, you can get really long runs, particularly when you're looking at the higher time frames of 4, and 8 hour daily time frames. And then finally, a Bollinger Band strategy as well. Bollinger Band is one of my favorite indicators. Used it a lot. So hopefully we get time to go through all of those. If not, we can do it again. I can pull out some of these and just concentrate on one. Pip Hunter's here. Good afternoon or good morning, my friend. Hope you're well. Anything you want to have a question about or ask about, please let me know, my friend. So yeah, swing trading. What is swing trading? What do we mean by what do I mean by swing trading? This is again a quote that Trevor wrote on one of his webinars. Yeah, this is free, obviously. You're not going to find the holy grail. There isn't a holy grail in trading. It's not. It just doesn't exist. Don't go around twitching your indicators or saying I don't need any indicators, or trying to get your trend line to fit what you think is there. There isn't such a thing. It's about exposure to the market. It's about discipline, patience, skill, repeating it, hard work, taking losses. That is really a big mantra that I talk about all the time. You've got to accept that you lose a lot in this business, and you just got to get up and dust yourself off. Personally, I'm having a pretty bad week when it comes to the markets at the moment. Things are not going very well, but what happens, that's what's happened. It's inevitable. So you've got to keep on top of it. So swing trading, speculative by its nature. So you can hold a position. Typically, I say my end of day trades typically 1 to 3 days. Sometimes they drift on 3 or 4 or 5 days. We're looking for the turn in the market. We're looking for the swing, the point, the pivot point, if you like. So we're looking, if the market's been going down, we're trying to catch the turn or see where the turn is, get the turn confirmed, and then run with the trade either up. If it's been going up and we're going down, we're trying to catch the swing top. You never catch the absolute top, you never catch the absolute bottom, but you're trying to capture as a swing trader, the majority of the move, or a big chunk of the move, or a comfortable bit of the move, that you're happy to take some profits on. Markets inevitably go up and down. The zigzagness of markets, you see that all the time, don't you, on charts, whether they're going up and down. Nothing goes up in a straight line. Life isn't like that. Sometimes they go like this, doesn't it? The ABCs, 1, 2, 3s, you've seen them all before, all different types of strategies, the W strategy, the M strategy, A, B, C, D, 1, 2, 3, 4, 5, the legs of different types of movements, the Dow principles, all that sort of stuff. So if all of what I've just said in the last 2 minutes doesn't make any sense to you, ask me, go back to basics, and we'll explain it all. But they don't move in straight lines, and a swing trader is looking for those turns. That's basically what we do. What you do need as a swing trader is liquidity and volatility. So you need things to be moving. Obviously, love him or hate him, but President Trump creates volatility, whether it's a tweet or a Truth Social post, some announcement that he's going to make or he's not going to make, or announcement he makes, or some throwaway remark in the Oval Office. That's creates volatility, and that's what we want. It can get a bit out of sorts when he's flipping from one way to another, but that's what you need as a swing trader. You're looking for turns in the market. So again, this is a Trevor quote, this one. This is liquidity is a friction on profits like commission or tax. So when you're trading, remember, there might be a commission for a particular trade, or if you're paying for tight spreads with a particular broker, there'll be a charge for in and out. So all of that is, a cost on your trading. And that's why swing trading is most effective on the higher time frames, because these costs can be quite excessive if you're trying to scalp it. But, if you're looking for 150 pips on the move, or 200 pips, or you're not looking for any target at all, you're just trailing your stop loss up or down as you move with the market. These costs become not irrelevant, but sort of minimized. But if you haven't got a market that's moving and you're trying to get it to move, or you're trying to think it's going to move and it only moves a pip or two and it comes back down, or 10 pips and you're looking for 50 pips, that's just going to cost you, price you out lots of false moves, a bit like the false moves you can get with moving averages. So liquidity is what you really want. The other thing is time frame. The best swing traders typically use the end of day time frame. A lot of the a lot of the market technical indicators that were created either in the last few years, or going back hundreds of years to some of the Japanese indicators. A lot of them were based on the daily time frame on markets that were open, commodity markets, forex markets, and typically it was an end of day entry and exit. And the thing I stick up on our Discord group every night, that's an end of day strategy that we run. It's not a mean reverting day trader. It's not for long-term investors that have bought at the beginning of the year or the beginning of the quarter and rebalance their portfolios every only a few times a year. Swing trading is looking for the move, looking for that zigzagness of the market. Okay, so it's like trends within trends. It says here many swing traders look at higher time frames. I certainly do. I've got a weekly and a monthly trend on my daily. I trade off the daily time frame, but it's important what the monthly and the weekly is doing. So if the weekly is long and the monthly is long, and I get a trigger to go along on my daily time frame, that's very much with the higher time frame. So I'm very much aggressive, or looking to take that a bit more aggressively. If the weekly's long and the monthly's short, that's not too bad. But if the weekly's short, the monthly's long, and I get a long trigger on my daily, that's even sort of better. So the shorter term, the medium term is against me, but the higher time frame is still long. So again, I'll be a bit more aggressive on that one. If the weekly's short, the monthly's short, and I get a long on the daily, that's very much against the time frame, against the higher time frame. So be a bit more sanguine, smaller position sizes. The trend is very much their friend, and that's very much how I take it. I'm very much a trend following trader, and again, I try to do this. You never fight the trend. There's no point, because they can go on and on and on. Okay, so typically an hour, 4 hour, but typically daily. time frames, hold for days, possibly weeks, or even a month. Sometimes I don't normally hold swing trades for much up to a month, to be honest. But again, I'm just talking about me. I'm sure a lot of you out there might approach this differently. So time frame, liquidity, and finally, there's that moves within moves. You think so? If the big thick line is the long, the long-term trend, the thinner one is the medium-term trend, and then the skinny one obviously zips around the shorter time frame trend along it within the higher time frames. It's all about sort of Dow theory: the longer time frame, the medium time frame, and the short time frame. So markets move in cycles and in waves, and it's moves within moves, and that's what we're looking for as a swing trader. Okay, so systematic, keep it a simple, well, I would argue as simple as possible, but have a system, trade your system, back test it, see if it works well enough, and as I say all the time, most strategies are good enough. It's the application by the individual trader that normally falls down. Trade your system, accept your losers. Many people find that very, very difficult. Particularly men traders. Women traders accept losing better than we do, guys, just because there's less testosterone flying around their bodies. We want to win all the time, fighting. Look at what's going on at the moment. Trump, Putin, Zelensky's getting sidelined, getting not very happy about it. NATO's getting sidelined. These big personalities, you've got to accept your losing trades. Bag your winners, let them run, and then just keep doing 1 to 4 and happy days. You'll get runs of where you think you're completely invincible, and you'll get runs where you think you can't do this and I'm losing too many trades. Nothing comes smoothly. A bit like swing trading. So we're already 20 past the hour, so let's crack on. So what makes a good swing trader? So typically they look at price action. Price action and technical analysis, I would argue, is the heart of a good swing trader. Lots of people these days are into things like VWAP, if they've got any technical analysis on their charts. Volume price of point of control. Lots of prop trading companies, when they first started, very much around these type of approaches, price action and very minimal technical analysis. Great at identifying trends, and that's just something I've done years, and it comes without thinking to me, to be honest. Avoid trying to know better, or go just think or try to fight or go against the trend. Again, swing traders just know where the higher time frame is and will resist trying to take trades that go against the higher time frame trend. A key skill which comes with time and training and analysis is the difference between a retrace and a reversal. A reversal's got to be a big move back down against the break of the trend. A retrace happens in all trends, whether we're going up or going down. There will be stalls. It's how much retracement we get. Is it 1%? Is it 10%? Is it 5%? How heavy is it? Is it in pip terms? So it's accepting that when the trend is over, it's over. You have your different parameters, whether it's a technical indicator, whether it's a fundamental indicator. They're saying this is over, we can turn around now, whether it's a candle pattern, whatever it is. They're very good at that. Lots of candlestick patterns. There's thousands, hundreds of candlestick patterns. Again, most swing traders will just focus in on a few that work best for them. Okay, I'm not saying any are better or worse than others. There's technique, there's analysis to show that some candle pattern formations do have better hit rates than others, but it's what works for you. Okay, if you can't see the candle pattern forming, but typically, again, whether it's a 5 candle pattern or a 3 candle pattern or even a 2 candle pattern, they're normally typically they're feed out after a 3 or 4 candles thereafter, after the candle formation has confirmed a position or a trade. So it's understanding that and getting that into your system and into your way of thinking. That's what swing traders do. They backtest their systems, their time frame, their personality fits them. They understand simple oscillators and indicators like trend lines, fib levels, and retracement levels. Oscillators again that work for them. So you got trend lines as well as sort of oscillators are more appropriate to reverse mean reverting type systems, but oscillators can work well for swing traders also. And again, that's like we talked about the other night. It's all about managing their emotions, being generally good traders. Whether you're a scalper, whether you're a swing trader, whether you're a long-term investor, whether you're doing 2 trades a week or 20 trades a day, all these things are still important. These last 2 bullet points are about managing your emotions and understanding yourselves and keeping risk management front and foremost of what you're doing. How much am I going to lose if this goes wrong? Can my system take this? How many open trades have I got? What's my current risk position? You are risk managers as traders. Successful traders that stay in business over the years are risk managers first and foremost. They manage their account, whether it's theirs, whether it's their company's, whether it's their family account, whatever it is. However they're doing it, they're always on top of how much exposure they have in the market and where their risk levels are, where they're going to get out, where they may get out, when they're losing, they know definitely where they're going to get out. When they're winning, you want to let it run. That's something I've changed a wee bit over the last couple of years, and get out at that point. So yeah, that's again, particularly about swing traders, but inheriting lots of other types of traders as well. So that's the background. That's what, in my view, makes a good swing trader. I don't know if anybody agrees or disagrees with me. Excuse me. It's been a long day today. It's quite hot in this room at the moment because it's been another miserable winter's day in dull old London. So first one we're going to look at tonight is the simple moving average and RSI combination. So we're looking at pullbacks and setups on the RSI. So what are we looking to use here is reduce the moving average down to 7 periods. So we're only counting back 7. We're going to use a simple moving average on this. And we're going to reduce the RSI from the standard default 14 down to a count back of 7. And then also, what we've done here is pull in the range where the market is either overbought or oversold. So we've brought the oversold area up from 30 to 35%, and we've brought the overbought area down from 70 to 65%. We keep the 50% level because we're going to use that as a second possible entry. And we're looking for the combination of the two. So for a buy trigger, for a first one, we want the price above the 7 period to break above the 7 period moving average, and then the RSI to come through the 35% level, so come out of the oversold area. If we're going to take a second position, this is a bit more if you're a bit more of a sophisticated trader or a bit more experienced, and you want to take a second position, you can add to the position, whether it's the same lot size or a bigger or smaller lot size. That's about money management. We talk about that at a different webinar. But a second position on the break of the 50% line on the RSI indicator. So again, good candles support you. Remember, good candles are big-bodied ones with little or no down wicks if we're looking to go long. Obviously, we invert this if we're looking to go short. So if we're looking to go short with this system, we're looking to come from below the 7 period moving average, and the RSI coming down out of the overbought area, down back through 65%. So that would take a short position. If you are going to take 2 positions, we put the stop loss at the lowest low of the last 5 candles. So we got the entry candle, and we count back 5 candles, and we put the stop loss. So stop loss can be quite a long way away, or the turn in the market. And if you take a second position on the break of the 50% line on the RSI, you want to be much tighter. So you just have the stop loss 2 candles behind, so 2 candles, so it trails it up. Okay, obviously if we're going to go short, we turn it on its head. Okay, let me show you an example of that. Okay, so we'll move in. We're looking for a move against the trend. That's a trade. Then we enter in 2 steps. The RSI at 35 or 60 and 50, and then the 2 stops to trail the stop loss of. We're looking for a tight stop to secure the profits and a big run from the other one. So this is what it looks like on a strongly trending market. So here, this happens to be the euro from a few years ago, but it's, I haven't got a better, cleaner chart than this one, to be honest. So you can see here, this is the RSI. There's the 35, there's the 65 levels. So you can see here, RSI has breached the 35 level. That's a first. It did that as this chart was, as this candle was complete. And so the first indicator is the break of the candle and close above the 7-period moving average. The following, or the same day, the RSI moves through the 35 as that's crossed. So it happens on the same day. Sometimes one lags, one is ahead of the other, and one lags. But either way, that's clearly your first entry on day one here, the 21st. Must have been a Friday. So entered either on the Friday night or the Monday morning in the first time. And then later on in the week, you can see the RSI continues to rise. The 7-period moving average is starting to turn up now from obviously a move down here. Our stop loss will be down here somewhere. We'll show you that in a minute. So we're continuing to move. So we add a second position. So we add a second position here as the RSI goes through the 50% level. Okay, this is nicely, it's a nice example, this. I mean, it doesn't quite often move this smoothly. And then you can see we've just stayed with it. We've got our two positions, one with a 5-count stop loss and one with a 2-count stop loss and we just trail this up for days and days and days, right through February until it turns around here at the beginning of March. The next slide shows you the stop loss on it. So here's the stop loss. So this is our 5-candle level. So that's our entry level here. So 1, 2, 3, 4, 5. The lowest level was this wick here, wasn't it? So that's our original 5-candle count back, the blue one. And our second entry, when we got here, as we went through the 50 period here, we count back 2 candles. So we've got in here, so it's 1, 2, and the low of that point is the red line. So you can see here, we've trailed our 2 stop losses up behind our move. The second entry gets taken out first because it's obviously closer to the price action. So we don't get all the way up here at 115 or whatever it was. We get stopped out all the way up here at 112.80 or something from an entry back here. Or this is an entry back here, wasn't it, at 107 or something. So it was a really strong trend that ran for nearly the best part of a month before it turned around quite nicely. So that was our second trade was stopped out first. Our first trade, again counting the it's quite a rollover. We get exited here. So we've gained from that blue line to that blue line, and from this this red line here up to here. So a very strong trend, and we've taken the vast majority of that move, haven't we? Obviously the 5 count back takes a while before it comes back. We see it came back quite quickly. So that's moving averages. Very, very useful in strong trending markets. This is a clear, simple, strong trending market. Use 7, add the RSI as an indicator to get out, and there we go. So you can see here, interestingly, the second exit coincided with a breach back under the 65 level on our RSI on that one. So that's the swing. That's what we're looking. This is a good demonstration of what we're looking for, the turn in the market. So this was the low of the market here. Can't see what was going on. And this was the top of the market, and we took a lot of that move. And similarly, it would have triggered on the way down here. You can see that there's the short position would have come on here. The stop loss would have been up here now. So this would reverse straight away. Count 5 candles back. It's still stop loss up there, isn't it? And then we come, that's the 50 there. So we'd have had a second entry on this day here. So we'd have gone short again on this close here. And again, that would have been still in profit, wouldn't it? It hasn't turned around up until there. So we've had a nice long profit on the way up, and we would have had a profit on the way down as we come back under the 7 period. The RSI has been in unison, and it's moved down with us as well. So a nice example of a very simple trend following strategy. So let me just show you that on our positions as well. If I hopefully everybody's got that. If I just put the demo layout. This is on. So again, this is live now. This is the gold market on the hourly basis now. So again, it's you know, we once you've got a move, you can use this on any market. So where was the last move? Well, the last big move was here, but we'd moved out of the we'd finally gone over the RSI here. Sorry, the RSI, the 7-period moving average here. So this is a simple 7-period moving average. There we are, moving average 7. RSI set at 7. You can see there's 65 and 35 for my indicators. So that would have been a long trigger, although we moved out there. So we'd either so there's only one entry there because it's, you know, the RSI is already over 50 as well as bursting out at 35. So we'd have been long there. Stop loss. Well, I mean, if you want to exaggerate, this is the problem with using it on the shorter term time frames. You get much more volatility on the intraday time frame. Obviously, you'd have had, you wouldn't have necessarily had your stop loss all the way down there, but you could have had it certainly there, and you just trailed that up as it's gone up. So you would have still been long, and it would have rolled over here, and you'd have got taken out there. We've gone under there, and we've come under, so that would have been a failed one if you'd tried to reverse at that point. There, it's gone back and stopped you out. It's gone down again here. And again, that's stopped you out, and it's chopped you out, and that's gone back long over there. So here on this hourly time frame, this is looking for another short position potentially, but it's moving up. So you can see the choppiness you get with the lower the time frame. So if we go up a time frame up to the 4-hour, it smooths it out a wee bit. There we are. You see. So again, we've got the short there. That's worked out there on that 4-hour. See, that's gone down, up, but it's still. You stop loss there, stop loss there, stop loss there at that point. And so you've got initial trade there. You could have had a second trade on that one there where we've gone through the 50, we've gone down again, but then reversed back up. So your stop loss would have been there. You'd have pulled it down to there, and it would have stopped you out as that's reversed there. This short would still be around about there, so you'd have got stopped out on that one as that's moved up there, and that's reversed, hasn't it? So that's gone back over the 7-period moving average. Okay, obviously the lower the number, the closer to the price action you are. So if we go to the daily time frame here on this one, you can see it's a strong trend. We haven't been taken out. That touched it. That might have taken you out there, but you would have got back in on that one there as it's rising. And we're in this overbought area and running. So there we go. The trend is very much with you at that point. And again, still, again, it's a good example of the strength of the gold market. 84.6 here with the RSI 7 as we are attempting to touch new all-time highs again at 29.26 at the moment. So yeah. There we go. Strong trend. You see how the 7 has supported that really nicely to the upside. Okay, so let's go back to the chart. Let's see. I'll get that. Where's my chart gone? I'm going to pull that back down there. So I'll do that in a minute. So next one is the parabolic SAR and MACD. What time we are? 35. So we might get through all 4 of these. Okay, so again, we're looking to use the strength of both of these indicators. Parabolic SAR is what it says. It's a parabolic. Parabolic means it's very strong. The move. It's quite extreme, or can be quite extreme, but it's a stop and reverse. So parabolic stop and reverse. Okay, and this is usually if we've got a strong uptrend, the parabolic SAR dots will be below the market, the price action. If we've got a strong downtrend, the parabolic SAR will be above the price action. If we've got a market that's slowing down or running out of a trend, the parabolic SAR might start flipping around from above to below the price action. If we've got a horizontal market, the parabolic SAR will stay one side of the price action, either above or below. Okay, so again, depends when you're going long or going short. It doesn't matter. The rules are still the same. You just turn them around. So it's a good indicator for looking for market swings, and that's what we're trying to do with swing trading. We're trying to see the turns. However, in strong trends, when a trend is established, i.e. in the weekly, in the monthly, we're in a strong trend, the parabolics on the day time frame can be flipping around. It can get a bit too aggressive. And as you come down the time frames, you can see the parabolics off flips around an awful lot at the lower the time frame goes, so it can be a bit too aggressive. So what we do here, we apply a slower moving indicator like the MACD. Remember, the MACD is looking at convergence and divergence based on the lagging moving averages. So we're trying to overcome the choppiness of the parabolic SAR by filtering the trend with the MACD. Okay, but we use the flip of the parabolic SAR to take our profit to get us out. Okay, the rules with this system are that it's the MACD that creates the first. So there's two signals. Okay, we need to see the parabolic SAR either above or below, and the MACD signal line crossing. The first signal, the first rule is that the MACD lines and the signal line have to cross. Once the lines have crossed, then we're looking for the parabolic SAR to have switched position already or switch position thereafter. That's when we go long or we go short. So if we're buying, we're looking obviously going long. If we're short, if we're going short, we're selling. And the stop loss should be below the high or low of the entry candlestick. Or again, you can, if you want to be a bit more conservative, you can have like two candlesticks behind. It doesn't need to be as far away as the parabolic SAR dot itself. I know some people use that, but that can be a long way away sometimes when we look at the charts in a minute. But we do use the parabolic SAR to the flip of the parabolic SAR to get us out. Okay, take profit. So, but you don't reverse like we were showing on the moving average system until the MACD has reversed. So the MACD is the driving indicator, and we use the parabolic SAR as the trigger indicator, if you like. Okay, so if I just go back to the same strategy here on the gold chart. So we'll bring up the live charts in a minute, but let's just have a quick look at this. Okay, this is from an MT4 platform where they haven't got the signal line and the MACD line. It's just the signal line. So we use the histogram. So again, you can see the here we've been in a downtrend. Here the signal line is in the histogram is inside the signal line, so that's our first entry. The parabolic size is a flip before, so we've got all of that run there as the signal line's gone up. Okay, you can see nice strong. When you've got strong trending markets like this, these strategies are great. But when you've got this consolidation phase like we got through here, you can see where the MACD's flat, the histogram's flat. You know, you get failed flips. So I was saying, you know, sometimes the parabolic SAR can flip when there isn't a trend. And that's what's happened there. You got two failed trades, but some big profits on the blue, the red, and the purple trade, and that just got you out there on that one. You see that? So again, different set, dollar CAD, different same setup. Okay, so this is what it looks like live in our trade locker setup. So this is again the gold chart. This is the 4-hour time frame on the gold chart. So we got the MACD signal line crossing there. So the we have the first cross there. You can see the parabolic SAR's already flipped all that way down there. So that's your first entry here. Let me just put that on here. So that's the entry there. That's your entry candle there. And again, you can either, as I say, you can have the candle. I would have had it sort of there. But again, that's just that's 2 candles or 3 candles from the entry candle. Some people have had it at the excuse me, at the bottom of that wick. Others, I say, would have had it on at the parabolic SAR, which seems a wee bit far away, but you can see it can get quite a long way away. So that's positive. The MACD's remained positive here. See, it's crossed there, and it's interesting. This time, it's crossed exactly the same time that the parabolic SAR flipped. So again, although that's a strong move, you haven't actually, this strategy hasn't given you very many pips out of that one, has it? Because it's reversed quite aggressively on that candle there. So we've got in there. It's a winning strategy nevertheless, but it's reversed. what we're looking to do now, because the MACD has sort of just for one candle dipped in, it's still rising. You see the K and the D line are still biased to the upside, aren't they? So we're still going up. We've had a little dip here, and see the histogram dip down. So we'll look, this is crossed again here. This is flipped, not there. So we'd have got in on that one there. So it's a continuation trade this time. So we've had one winning trade. That's another trade, and off we go again. And the parabolic SAR flips there. And again, it's a minor win on this one. That's my horizontal line. So it's flipped there. So you would this would decide during this candle. Again, not a great deal of pips in that one, having ran all that way, but that's that's the rules, isn't it? However, I was saying the wait for the parabolic SAR to flip. What happened on this particular occasion was that the MACD actually flipped the candle before, and it's quite a significant turn at that point. So you would have had the option to actually get out there where I'm waiting for the parabolic SAR to flip. So the parabolic SAR has delayed this time. But what we are looking to do now is go short. So that is a short position. So you've either got out there and gone short there, or you've got out here and gone short at the same time. So it's a similar short, because you can see that how the MACD lines have rolled over. We're starting to move down. So we've had this trend up. You can see where we've been sort of trending up here. Let's change that. Change the color of that to yellow so you can see it a bit better. Okay. So we've generally been with the trend here. You see how the trend's gone up? MACD signal line's been with the trend. Histograms are positive. But at this point, we turn over, we roll over, we've got a deviation, but it doesn't last for very long, does it? So we've gone short here. That's still moving down, but this flips. So we've gone short at this point here. And this time it's a losing trade because we've gone short here and it's gone against us, and then it flips at this point. But this is moving down, so we're out of that. That's our closing losing trade, but we haven't gone short because the nothing's we'd already, the parabolic, by the time the parabolics are flipped, it flipped to go long. So we get in again here, we go long again at this point here on that candle there. And again, remember this is the 4-hour time frame, so it's not it's not the where's it? It's crossed there, so it's actually that time frame there. So we got in there and rallied up. That's flipped at that point. So again, that's actually ended up a losing trade, hasn't it? It's gone on the flip there, but again, you see it's crossed at the same time, so it's definitely out. It's a flat trade, that one, and that's gone short to there, and then it's flipped. That's a losing one as well on that there. So it hasn't been particularly effective on this strong trend here on this 4-hour. If we take all those lines off and we go up to the daily time frame, take this up to the next level. So that's why a lot of swing traders look at the daily time frame, and not much below it. You can see some of these on. The last big trend cross here for the MACD was back here on the 2nd of January. I think we showed you this before, haven't we? I've shown this before. So that's the MACD cross. We're looking to get long, but the parabolic SAR is still short. So it finally flips there. So we actually, they're in unison here as far as the 8th. So a few days later. And then we've just run. It's kept you in, hasn't it? We're trailing our stop loss up, trailing our stop loss up, trailing our stop loss up, trailing our stop loss up. And that's where my stop loss would currently be. And I'm sure I've got a strategy that's running that on the gold market at 28.55 on an end of day basis. Got a bit scary this week, but that's where the stop loss would currently be with this strategy. So again, you can see the higher time frames much more effective, less trades obviously, But you can see the strength of both the parabolic SAR and the MACD in unison then when we got a strong trend. Obviously, didn't know that was going to happen here, did we? We were chopping around. Nice move down here. Looked up, didn't work out. Didn't cross again, looked to go short here, right at the bottom, really. Didn't work out. That's short. Went against you, got out there. And then finally got the final strong long on the 8th here, and we haven't looked back since. And that's, that's the art of trend following and swing trading. And so, I was saying about days and weeks. Well, this one certainly is weeks, isn't it? 8th of January, and no looking back as we've trailed our stop loss up. Thank you very much. So that's the MACD and the parabolic SAR. Again, one that we I show you and use before, used many times before. Okay. Next one, third one. Might just about time to get all three of them in here. Is the crossing moving average strategy. Again, something I've shown you before. Again, this approach uses the 3, the 5, and the 21 exponential moving average here. Again, 4 hours minimum daily is more appropriate. We're looking for, baby bear, mummy bear, daddy bear, short term, short, medium, long, 3, 5, 21. So you want to be with the trend. The key with this trend strategy is alignment. You need your lines in order. Okay, baby bear, mummy bear, daddy bear. Short, medium, long. 1, 2, 3. Be long when the long term now, and only short when below the 21 EMA. Means long or short, simple FX strategy. Very, very simple. When the short term moves between the 5 and the 9, you get out, so no trade, so you're flat. The problem with moving averages, although I'm a great fan of them, I use them all the time, even now, 30 years later, it's their laggingness. Laggingness, is that a proper word? I've put it in lines. You can get in after a move start, but they're not a great system timing element, but they are great for major moves, like we've just seen on the gold market with the parabolic SAR and the MACD. So major moves, trending markets performs poorly when we're going sideways, which I'm sure you all seen before and know before, and it's probably put you out before. So again, this is from my old MT4, MT5 platform. So again, same strategy, the daily with the 5, the 9, sorry, the 3, the 5, and the 21. The red line is the one that's closest to the price action. That's the 3. So the 3 crosses the 5 here. You can see the red line crossing the blue line. But it's a few candles late, a few days late before we finally cross the 21, the E. So we go long here, and we're all in a, we're in alignment from here. So this is what I mean by alignment. We've got 21, 9, and 5 and the 3. So we're in alignment. There's no cross. Soon as the one of the moving average crosses another one. So here we've got the 3 crossing the 5. We get out here. Okay, so we're out. We're flat because we're not in alignment. Next alignment comes here when we've got here at the red arrow, where we're under the yellow again, the 21, the 3 and the 5 are in alignment. You can see there's gaps between them. So we got 21, 5 and 3, yellow, blue, red, and then we get the red crossing the blue again here. So we're out of alignment here. Didn't last very long this time. We went up and then came down back quickly, and there's lots of chopping around here. So just above didn't happen. Crossing and out is there. So we got yellow, blue, red. Here as we go up, we've got yellow, blue, red, but only for a couple of candles before it turns around and stops us out. So that was a failed trade. That's here we got yellow, blue, red. We've gone short at 5 and out at 6 when they cross back up. Next cross was here at 7, where we've got yellow, blue, red here on 7, and we cross at 8, so we're out. Here we got a continuation trade because we're now see they just crossed there at 8. You can't see that from that, but here we got yellow, blue, red going long this time, and off we go. So alignment all the way up here, and massive profits on this massive move here. Some lost trades here. These are flat positions as we've gone sideways, winner here, winner here, winner here. So trending markets can be very powerful. They can go on for a long time. 5, 3, 5, and 9 exponential moving averages. We're looking for a cross of the slow and the fast and the medium, and then a final trigger is the cross of the slow moving one, the 21 EMA here, to take you long here. Similar thing here, different colors, but magenta, yellow, and green this time. And you can see cross down again. So we got magenta, yellow, green, all nicely in alignment. 20 period, fine, yet moving average. So down we go, down we go. And we've got a turn here as that one ended. That to be the DAX. Okay, there we go. Same thing. So there's the green under. So we've gone short here. It's come back against 3, 4. It's been a flat one, but 5 to wherever. Still open to the downside. Okay, so that's the moving averages. And again, if I show you it on our Trend Locker platform, it's I haven't actually got the let me put it on here. So if I take this is the if we go back to the actually I'll show you the. So this is the same strategy. So it's got 5, 9, and 21 on this one, as opposed to 3, 9, and 21. So ignore the MACD and the RSI on this one. We're just looking at the moving averages. What's this? This is gold again, and again you can see. So the red, again, just these 3 here: the red, the green, and the orange on here. So here we've had the first. There we are, 12th of February here on this 1 hour moving average strategy. Cross of the orange and the 5 and the 9 here, as it happens to be. It could have been the 3 and the 5 was the cross. We're above the 21 here, so we're long here. Stop loss down here again. Off we go, and we're aligned all the way. It hasn't crossed still, so we're still in that. Although we would have probably been taken out as we're strolling out. We're scrolling. Oh, I can't speak. We're trailing, not scrolling, you old fool. We're trailing our stop loss up here, or we use the mid moving average as our get out. So we'd have got out here as it's gone through the mid moving average. We'd have got back in here the following candle, because we're still in alignment. We've gone up, but then we've reversed out quite aggressively there. But they didn't cross. Interestingly, you see that? If you zoom in, it's a big down day there on the 13th. Today, isn't it? It's the hourly candle I'm looking at here. So we had a big down hour at 1 o'clock, but we bounced back at 2 o'clock. So, you know, you would have been taken out there, but you'd have been long from here. Again, if you'd used the moving average as your get out, you'd have been taken out there, but you would still be long because they're still in alignment. See how they're in, see what I mean by I'm staying in alignment? And remember, this is not the this is the 5, the 9, and the 21. They're in alignment. So we got a trending day here on the hourly time frame for gold. Okay, remember talking about swing trade. So you can swing trade at these lower time frames, but it's more volatile. If we go up to the hourly, the 4 hourly time, so it's a wee bit cooler. Less volatile, I'm trying to say. So we've been here, all see how they're all in alignment, didn't cross, still in alignment, came close, but they might have, yeah, they crossed there, I think, but the 20 on that cross there, but you got back in on this hour, on that candle there on the 6th of February. Yeah, it depends where you'd got, how close you got your stop loss on that one, but yeah, you'd probably have had it still down here. You might have been taken out those days, but got in again there, got in again there. Off it's gone, come back and taking you out there. Now we did get across here on the 4 hour here, on this one here, see the blues cross there. On this particular setup, the 5 and the 9 have crossed, and then you've gone short here a couple of candles later. That would have been a short, but again, it's immediately taken you out, so that's a losing trade. But you'll have immediately gone long again because the actually they didn't cross, did they? What did they? Yes, the orange is, yeah. So the orange has gone. So it's not until that candle there, that although that's gone under the 21 and come back up, this hasn't. We haven't. I think we either crossed there. Yeah. So you'd have got in on this candle here, the 3 o'clock candle yesterday, and you've been long ever since. Again, that wick might have taken you out if you got your stop loss too tight. But here we are looking for all-time highs again for the gold market here on the 4 hour. Okay, and again, just to finish things off. Daily, where are we? 5 minutes. The daily remains, nicely aligned. There we go. There's the moving averages, like a bit like the MACD and the parabolic SAR. Absolutely no reason to be panicking or getting out of that. And as we all know, it's been a very, very strong January and February so far, 2 weeks in to the gold market. And Trump speaking taking questions in the Oval Office. I can see on my Bloomberg feed here. Some of the questions last night were crazy. Attorney General's quit. Gold climbs towards another record with Trump's tariff announcements. There we go. As we're speaking, you see the impact of reciprocal trade tariffs adding to the bid on gold. So much stuff flying around at the moment: politics, geopolitics, fundamentals, technicals. But the trend is very, very set there on gold. But when it crashes, it could move down quite aggressively if everything suddenly calms down and gets cool. But the moment, gold is being gobbled up by everyone from central banks to you and I, my friends. So there we go. It's 5 to 8. I do need to wrap this up at 8 o'clock, I'm afraid. So I'm going to leave the final one. I'll do a separate session on a couple of the others. So the Bollinger Band setup, and I've got a Fibonacci swing trade setup as well. So I'll produce some separate slides to look at using the Bollinger Bands and Fibonacci and some other oscillators as swing trading turns. Okay, I hope you don't mind. Those of you that are still here. I'll get some messages. So let's have a look. Where are we? There's my restream gone. What's happened? Oh, we're here, aren't we? Sorry. You're here. Yeah, still here. No more questions. Sorry. Right. So let's move on. So I'll do this one another day. Okay. The moving average setup. Okay, because I do need to go. Big thing is the squeeze or the pinch when we get moving on the inside. But we'll go through this another day because I say time's up. I'm not going to keep going. thePropTrade.com. Swing trades different to day trading, investing, as we said at the moment. Technical analysis is great for swing traders. Its timing is so important. This ABCD, ziggy-zagness of nature. That's what swing traders do. Have a system, trade your system, accept your losers, bank your winners, repeat as often as you like. So the 3 books I talked about earlier in the week. Again, somebody asked me about that again today. They're all quite old books, but they stand the test of time. If you call yourself a trader, whether you're a prop trader, a futures trader, you're trading with us for the first time, or you've been trading with us for months, read these books, my friends. They will really open your eyes. So today we have covered what is swing trading, liquidity, time frame, and a systematic approach. I've explained why that's so important. The characteristics and traits of a swing trader. Your personality is so important to success in trading, my friends. So keep it in mind. We've looked at a simple moving average RSI. We've tweaked the RSI. We've seen the parabolic SAR and MACD approach. We looked at a trend following exponential moving average, simple crossing strategy using the 3, the 5, and the 21. We didn't look at the Bollinger Bands. We'll look at that another time, and we'll also look at using the Fibonacci levels for swing trading as well. The key Fibonacci levels, the 15, the 61.8. I'll do that another day. Okay. So thank you for your time. As ever, more information on thePropTrade.com. If you're not with us, why? Come and open an account. We're here to help you. I'm here to help you principally as well. Remember, it's all about you. So thanks for your time, everyone. We'll see you again tomorrow. Tomorrow's Friday. We'll be looking at US retail sales and see if the president's got anything else to say. He's chatting away here to his the news people that he's allowed in the Oval Office. Everybody agrees with him basically. So see how that moves markets. But gold is on a run, as we've just seen there. So see if we can get a breakout for our Bitcoin friends as well. So see you all tomorrow. retail sales and a wrap up for the week. Take care, everyone. Good night. Bye-bye.